Today, we will talk about how to purchase a small business. Let's have a look at the details. One way to become a business owner is to purchase a small business. Buying a small business is probably less risky than starting your own. However, it may not be cheaper. You will need to hire professionals to help you value the business and draft necessary legal documents. You also need to start early on finding financing. When you complete the sale, be sure to file the necessary paperwork with the government. The first step is finding the necessary help. Think about hiring a business broker. A business broker can help you by finding and valuing potential businesses. They may also help you in the negotiation process. Hire a lawyer. You probably should have a lawyer help you with the process. An experienced lawyer can help you properly value the business and make a competitive bid. Consult with an accountant. You probably will also need an accountant's help to understand the financial documents you are looking at. Visit your nearest Small Business Administration office. The SBA and local resource partners provide mentoring, counseling, and training. The second step is analyzing the business. Draft a letter of intent, LOI. This document opens the discussions. It is not an offer, and it doesn't commit you to buy the business. However, it is a way to stop anyone else from buying the business while you investigate it. Sign a confidentiality agreement. Business owners might hesitate to show you the books if they think you will disclose to others the financial condition. Study financial statements. Get copies of the financial statements for the past 3 to 5 years. They should be audited statements, with an audit letter from a CPA firm. Examine tax returns. Don't make an offer until you look at the business's tax returns for the past 3 to 5 years. By studying the returns, you can gauge how profitable the business has been as well as its tax liability. Ask to see accounts payable and receivable. You can determine the business's cash flow by separating out 30, 60, and 90-day accounts receivable and accounts payable. Review current liabilities and debts. A profitable business could have high liabilities, so you need to check if the business is facing any legal issues. Look at other important documents. In addition to tax returns and financial statements, you also want to request and study the following business documents before making an offer: contracts and leases, customer lists, and employee and management contracts. Investigate the business's reputation. You can't rely only on numbers and spreadsheets. Instead, you need to understand how well respected the business is. If you buy a business with a poor reputation, then you are setting yourself up to fail. Discuss whether the current owner will stay. You should discuss any employment considerations, such as salary and fringe benefits. Consider the business's potential for success. A business that has been successful in the past might not remain that way. You should consider whether the business is likely to succeed in the future. The third step is obtaining financing. Identify different potential sources of funding. Unless you have a pile of cash on hand, you will need financing in order to buy the small business. Consider a ROBS. With a ROBS, you use the equity built up in a retirement account such as 401k or 403b. You can free up the money to use within 3 to 4 weeks. You won't incur taxes or penalties. Research SBA loans. You don't get an SBA loan from the Small Business Administration. Instead, you get one with a bank and the SBA backs it. Draft a business plan. If you want to get a loan from a bank, even an SBA loan, you will need to show the lender a business plan. Start the loan process early. Each lender has different requirements and different forms you will need to complete. You should call as soon as possible. And the fourth step is closing on the business. Adjust your offering price. You might need to adjust the price based on your due diligence. You should negotiate with the owner. The price should reflect the following: any prorated rent, utility, and other fees, the value of inventory, accounts receivable and accounts payable. Enter a sales agreement. You should have your lawyer draft a sales agreement. If the seller's lawyer drafts it, then you can have your lawyer review it. Review required documents. You want to make sure the sale is legal, so there are many documents you and your lawyer will have to review at the closing. Obtain a bill of sale. The bill of sale is proof that the sale has gone through. At the closing, you and your attorney should review it. Complete the closing or settlement sheet. This document lists the details of the sale. You should have negotiated or addressed everything listed on the settlement sheet. Handle security agreements. When you received financing, you probably had to pledge assets as security for the loan. This means that if you default, your creditor can seize the assets. In closing, you probably had to sign security agreements. Complete the appropriate IRS form. You must complete IRS Form 8594 Asset Acquisition Statement. The form indicates the amount of the assets and how you purchased the business. You will need this information for your tax return. Thanks for watching this video. Please don't forget to like and subscribe to our channel if you like our videos.